Hey gang, we're now going to take a look at what's included in the estate of a decedent. And remember, you're always going to use the fair market value at date of death or the alternative valuation date. And the alternative valuation date is when you distributed it, but never more than 6 months after death. Remember, 6 months, 6 feet underneath, they bury us, right? So we're going to take a look at these items and see which ones are still pulled back into the estate, even if the party tried to get rid of it before they died. So let's take a look at some of these examples. Sarah owns a house with her husband, Terry, who purchased the house for $225,000 5 years prior to their marriage. At death, and by the way, Sarah's the one who dies, the fair market value of the house is $425,000. At Sarah's death, Terry becomes the sole owner. Remember, in this particular case, for her estate, we're going to include half of the fair market value at date of death. So 50% of the value is going to be included. So property held jointly with a spouse is considered qualified joint interest. 1/2 of the value of the property is included in the decedent's gross estate, regardless of the consideration provided by either spouse. Because Sarah owned the house jointly with her husband, 50% in this case, the fair market value of the house is included in her gross estate. The fact that Terry provided all of the purchase price does not matter. It is irrelevant. The next scenario that we have here is Sarah and her daughter Dora opened a joint checking account at First Bank 3 months before her death. Sarah deposited $100,000 into the account. Dora made no deposits. At her death, the balance is $62,000. Well, the $62,000 will be included because she deposited all the funds. Dora put in nothing. Deposits to a joint bank account are considered incomplete transfers. They're not gifts until the account holder withdraws the money in excess of his or her deposits. Because Sarah made all the deposits into the account, the remaining account balance is considered owned by Sarah. Thus, it's included in her gross estate. The next item was Sarah's husband, Terry, owned $500,000 life insurance policy on Sarah. Terry was the sole beneficiary, so he bought it, paid for it, and owned it himself. The life insurance proceeds will not be included in her estate because Sarah was not the owner of the policy, nor was her estate the beneficiary of the policy. Now, life insurance on a decedent's life is includable in the decedent's gross estate if the decedent had incidents of ownership or the decedent's estate is the beneficiary. To give you an example, if I have an insurance policy and I name my wife as the beneficiary, or I name my sister, or I name my brother, but I can change the beneficiary at any time, right up until the time I die. Well, then I have incidents of ownership. And then, even though at date of death, the insurance will go to them, and it's not taxable income, it will still be part of my gross estate because I had the power, the incidents of ownership. But in this case, because Terry owned the life insurance policy and was also the beneficiary, none of the proceeds will be included in his gross estate. The next item is Sarah owned a red sports car, purchased as a gift 5 years ago from her husband, Terry. The date of death value of the car shall be included in her estate. Assets received by gift are includable in the decedent's gross estate. The fair market value of the car at her date of death is included in the estate. The next item is 2 years prior to her death, Sarah transferred $350,000 to a, and here's the critical words, revocable trust. She can change her mind. She can take the money back. Her sister Sally is the beneficiary of the trust. At Sarah's death, the trust had assets now worth $450,000. That's includable. Transfers to a revocable trust are considered incomplete gifts. They're not gifts. If at death the decedent holds the power to revoke, alter, amend, or terminate an interest in a previous transfer, the fair market value of the property at the date of death is included in the decedent's gross estate. Sarah's gross estate will include the revocable trust assets, and it will be $450,000, the value at her date of death. And then we have the following item. Sarah worked through the day before her death. Her estate receives her final paycheck of $2,300 1 week after her death. That's income in respect of a decedent, isn't it? Sarah's final paycheck is included in her gross estate as income in respect of a decedent. So in this particular case, income in respect of a decedent, known as IRD, is income earned by the decedent prior to their death, but not collected prior to their death. So in this case, it's included in her gross estate because the decedent had an interest in the property, the right to receive it at her moment of death. Sarah's gross estate will include the $2,300 as accrued wages, so it's not only taxable to the estate as income, but then it will also be considered part of the value of the estate for estate tax purposes on that value.